Okay, so let's move on then to banking. And we mentioned Credit Suisse on Wednesday, or David did, but let's bring that up to date. So events have taken a turn over the last day or so. So here's the Credit Suisse website. Let's see, they issued a statement. They said, we've taken the decision to preemptively strengthen the bank's liquidity by borrowing 50 billion Swiss francs. That's roughly $54 billion from the Swiss Central Bank under a loan facility and short-term liquidity facility. That resulted in the stocks had been going off the cliff. That resulted in a slight rebound, as you can see there. But today, in fact, as the news has sort of permeated people's minds, things starting to head south again. So Credit Suisse stocks nearly 2% down today. But if we look actually at the longer term picture, Credit Suisse stocks have been falling for 5 years or more already. So there's a recognition of a significant problem there. Of course, Credit Suisse getting this bailout because they're considered a systemically relevant financial institution, but they've been losing customers hand over fist. And the thing that triggered this was the announcement by the chairman of the Saudi National Bank that they were not going to continue further investment in Credit Suisse. So they're signaling that they saw problems with it. What are those problems? Well, obviously Credit Suisse implying liquidity issues, which is why they've taken these loans. But if we look at the risk of default, one way of recognizing whether an institution is going to default on its debts is credit default swaps, were effectively a derivative of an insurance policy, give an indication of Credit Suisse's creditworthiness. This was the news from yesterday. Credit Suisse default swaps are 18 times more expensive to buy than UBS, 9 times more expensive to buy than Deutsche Bank. And what this article is saying is that the cost of insuring the bonds of Credit Suisse Group against default in the near term is approaching a rarely seen level that typically signals serious investor concerns. The last recorded quote for credit default swaps for 1 year maturity was 835.9 basis points, but it had gone as high as 1,200. That came down again a little bit yesterday, but still what the Bloomberg at least was calling, a really significant skepticism in the markets about Credit Suisse's creditworthiness. Rumors today circulating that Credit Suisse has absolutely huge derivatives exposure. And of course, the one thing that nobody really understands, if you'd say that there's a headline figure of a couple of quadrillion of outstanding derivatives contracts out there, nobody understands that if the dominoes fall, or how those dominoes are going to fall, and whether in fact those derivatives contracts would net themselves out in any kind of normal way, or whether it would just collapse in a massive heap. Certainly Credit Suisse had massive exposure to that, and a big potential problem.
Yeah, everyone was screaming about after the collapse of Silicon Valley Bank, and it was saying the U.S. banking system is basically on the verge of collapse. There was a lot of panic last week over the weekend, and what a lot of smart pundits were saying was, hey, do you realize in terms of fragility, the European banking landscape is much more fragile and in fact less robust than the United States, because the United States is more diverse in terms of banking, and we have this great network it's shrinking, of regional banks. But there's also too big to fails in Europe that are totally over leveraged. And what happened, and they're also going to be suffering from U.S. Interest rate hikes and things like that. They're all into bonds, they're all into hyperinflated assets. There's a potential housing bubble as well on the back end of this. In countries like even the UK, you could put it in that category.
100%.
So there's a lot of problems here with the European system. So look, but in America, we'll talk about that in a second. What's happened, Mike, is that the U.S. government has intervened. Joe Biden, they panicked, they intervened. A lot of people say this was a good move. A lot of people say it was a bad move to protect all depositors, okay? So, but what they have done is they have basically changed the playing field in a way. They've nationalized banking in the United States, whereby if the federal government is going to guarantee all depositors to any level, then that also can encourage banks to indulge in risk taking, knowing that they're going to be bailed out. And certainly this, Joe Biden says no cost will be borne by the taxpayer. This is a total lie. There's a massive open window loan fund for banks to tap into for a year. That could go into the trillions, okay? And this is massive quantitative easing. That's going to trigger more inflation, and everyone is going to bear the cost of that.
Yeah. We're going to be talking more about this on Monday, but the scale of the reversal, because of course there's been quantitative tightening in the United States for the last year or so. They've been reducing the levels of quantitative easing, but they've more or less, well, it's significantly reversed that. David's going to be talking about that on Monday.
But still, real inflation's about 20%.
Yes.
In America, and they just can't do anything about it, and this is going to exacerbate that problem.
Well, they can't do anything about it because they've run out of ammunition, effectively. The other point to make on this, we mentioned on Wednesday, Patrick, is it's actually what Biden has done is actually illegal in the United States. It's against the legislation that they have with respect to providing insurance for bank deposits, which puts a fixed limit, a hard limit of $250,000 on that. So,
well, there's a debate that this should be adjusted for inflation every year. Yeah. The whole thing is being relooked at. But the takeaway is all the big institutions, like a Saudi Arabia, for instance, but in the U.S., all these companies that some of them had billions in Silicon Valley Bank. Now they're saying we're not going to have more than 10, 20% in any bank. They're pulling their money out, so no large deposits in any of these banks. But the regulatory pressure on the small to regional banks is going to be so great, so all the big banks are going to benefit. So this is a massive consolidation back to the big banks, to Jamie Dimon, J.P. Morgan, okay? And so that what about small to medium-sized businesses? Who's going to service? Who's going to give loans? And the other thing, Mike, if we consolidate the banking system in the United States or Europe, and you only have 4 or 5 major banks, they become a utility. And guess what? Their terms and conditions, ESG, woke, cancel your account. You see what these big players are doing to people if they don't like this talk on social media, shutting their PayPal accounts down. All of this stuff comes into play.
Yes.
Because you have less diversity in terms of what you have available. Canada has this. Massively regulated, pretty much everything's guaranteed and backed up by the government, huge amounts of regulation. It's become a utility in Canada.
Yeah.
So this is the direction the US and Europe might be going, and this also means if they want to introduce a central bank digital currency, a CBDC, this type of an environment would be ideal for something like that. The decision is made, and it's not going to be your decision.
100%.
It's being made at the banking level. So,
but what about First Republic?
Well, the shenanigans continue here. So Wall Street banks lining up here to save. They plug a hole, $30 billion in the beleaguered First Republic Bank. Okay, and mind you, Silicon Valley Bank had a $2 billion hole. That could have easily been plugged if they had just got their compliance paperwork together and it wasn't leaked to the press and everyone went crazy. But of course, the rest is history. So here's Janet Yellen, and this is the problem, Mike, okay? She's become a politicized Treasury Secretary, and she doesn't quite know what she's doing, at least when you listen to her. It doesn't seem like she's all there. So here's the long and the short of this bailout. Let's look at this. Well, what they've asked is the banks to come in and rescue this guy. So 11 of the nation's largest banks announced on Thursday they would deposit $30 billion into First Republic. Okay, so this is an emergency intervention here, spurred on with the support of the government. Bank of America, Citigroup, J.P. Morgan, Chase, Wells Fargo, all putting in $5 billion into First Republic. Goldman and Morgan Stanley chucking in $2.5 billion here. So another bank that's requiring propping up here. So arguably, this is a better solution to help spread the risk here. This is the banking community, as it were, trying to solve the problem without having to go to the begging bowl. But the begging bowl's open, Mike. They've opened a window for a year. All these guys can pull loans for overheads or to cover anything. And we don't know where that's going to end. It could be $1 trillion. They say it's a multi-trillion-dollar facility. But look at the TARP. How high did that go? What's the real cost of the bailouts in 2008? Was it 36? I've seen 36 trillion. I've seen as high as 300 trillion in real terms. We don't know. Can we see the audited Fed balance sheets? I mean,
No.
look, okay, so here's Janet Yellen. And this is what she's been busy doing. She's hanging out with Zelensky. You can see the look on his face. He's probably scared he's going to have to kiss her like Nancy Pelosi. But so she's in Kyiv. These banks are going completely haywire, no compliance. They're engaging in all sorts of risky, bad management, everything. She's in Ukraine guaranteeing state pensions for Ukrainian government employees from the U.S. government, the U.S. Treasury. So she's totally politicized. So this is the Biden administration. This is the U.S. government. Everything is politicized now. And so we're going to call this woke capital. Okay, this is the beginning of our woke capital. So let's take a look at woke capital. Look at this. Did you know, Mike? Go woke, go broke. Silicon Valley Bank hired a board obsessed with diversity, invested in $5 billion for a healthier planet, held a month-long Pride celebration, but had no chief risk officer for 8 months last year. So they're doing all these woke events and things like this. So let's take a look at how bad this was. Again, woke capital. They got an A rating for their ESGs, fantastic, and increasing diversity and investing in all these sustainable startups, wonderful. And for 8 months last year, they had no chief risk officer. So they didn't feel it was important to plug that position to get the person they actually needed. They're busy doing woke capital. So here it's investing clients' money in low interest government bonds and securities that saw their value fall when interest rates rose. So it was a disaster. Everyone knew it was a disaster on the inside, but nobody saw it, nobody could say anything about it at the time. So here's Credit Suisse, and I want to introduce everybody to Credit Suisse. That's the one that's in trouble, right?
Yes.
So here's Pips Bunce. He's the head of global markets at Credit Suisse. And yeah.
Sorry, which one is Pips Bunce?
It's the same. It's he's gender fluid, non-binary, and you'll see he's been recognized for this. Let's take a look at this. Wow. Oh, congratulations to Pips Bunce on being listed as one of the top 100 female executives in 2018. So, I mean, I am truly honored and humbled by this award. I'm proud to be proud of the progress we're making towards all forms of gender diversity and equity. So he shattered the glass ceiling there. That's just fantastic. Really paving the way for women to come from, to follow those footsteps. I mean, how wonderful. So this is woke capital at work, Mike. So do you see a pattern developing here? Governments, institutions being obsessed with ticking the woke boxes, and meanwhile, the whole thing is falling apart.
Yes.
Rome is burning, and they're standing up there with their pink knitted caps, as Nero did, watching the spectacle.
Yes.
So who
good.
knows? Yeah.
Okay.